You're listening to the Bare Metal Cyber Prepcast, created to help you succeed in your educational journey. Learn more at baremetalcyber.com, where additional prepcasts, books, and training materials await. Let's get started. The Gramm-Leach-Bliley Act, or GLBA, is a central U.S. law governing financial privacy and security. Enacted in 1999, it was part of a broader modernization of the financial services industry, allowing affiliations among banks, insurers, and securities firms. At the same time, Congress recognized that combining services increased the amount of sensitive information handled by financial institutions, so it imposed new privacy and security requirements. GLBA established a dual framework: the Privacy Rule, which governs how institutions notify customers and limit sharing of non-public personal information, and the Safeguards Rule, which requires comprehensive security programs. For learners, GLBA demonstrates how privacy protections are tailored to specific industries. Financial institutions sit at the core of consumer trust, holding data that can expose individuals to fraud or identity theft if misused. The law balances business flexibility with consumer rights and security obligations. GLBA applies to covered financial institutions, defined broadly as companies offering financial products or services to individuals for personal, family, or household purposes. This includes banks, credit unions, mortgage lenders, payday lenders, insurance companies, investment advisors, and even some non-traditional entities like check cashing services or auto dealers providing financing. The scope of non-public personal information is similarly wide, covering any personally identifiable financial information collected about a consumer in connection with financial services. For learners, these definitions show how GLBA ensures that privacy protections extend across the diverse financial ecosystem. Whether a consumer is opening a bank account, applying for a mortgage, or purchasing insurance, their information is covered under the statute. The Privacy Rule requires institutions to provide an initial privacy notice when a customer relationship is established, explaining how the institution collects, uses, and shares non-public personal information. This notice must be clear, conspicuous, and delivered in a timely manner, often at account opening or before information is shared. Institutions must also provide annual notices for continuing customers, reminding them of their privacy rights and any changes in practices. For learners, these notice obligations highlight the theme of transparency. The law does not prohibit all data sharing, but it ensures consumers are informed and given a chance to exercise control. Notices turn complex information flows into actionable disclosures that empower individuals. Opt-out rights are central to GLBA. When institutions wish to share non-public personal information with non-affiliated third parties for purposes beyond certain exceptions, they must provide customers with an opportunity to decline. Consumers typically receive a form or electronic option to exercise this right, which institutions must honor. However, there are permitted exceptions, such as disclosures to service providers performing functions on behalf of the institution or to comply with legal requirements. For learners, opt-out rights demonstrate GLBA's balance between consumer control and operational necessity. It does not require consent for every disclosure, but ensures that individuals can block marketing-driven sharing with unrelated companies. To facilitate compliance, regulators developed model forms that institutions may use for both initial and annual notices. These forms standardize the content and format, ensuring clarity and reducing consumer confusion. Institutions that use the model form are deemed to meet the requirement for being clear and conspicuous. For learners, this shows how law and regulation recognize the importance of usability. Privacy notices lose their value if they are incomprehensible. By promoting standardized, plain-language disclosures, regulators help ensure that consumers can understand and act on their rights. Affiliate sharing is another important area where GLBA intersects with the Fair Credit Reporting Act. Institutions may share information with affiliates under certain conditions, but restrictions apply when the data is used for marketing. Consumers must be provided with notice and an opportunity to limit such uses, known as the affiliate marketing opt-out. For learners, this illustrates how privacy regimes are interwoven. GLBA addresses the collection and sharing of non-public personal information, while FCRA provides guardrails around how shared data is used for eligibility and marketing. Together, they create a layered framework that governs both flows of information and its downstream use. The privacy rule also includes service provider and joint marketing exceptions. Institutions may share information with non-affiliated third parties that perform services or functions on their behalf, provided contractual agreements require those third parties to maintain confidentiality. Similarly, institutions may jointly market financial products with another entity, such as a bank and an insurance company, without triggering opt-out rights, as long as disclosures are clear. For learners, these exceptions highlight how the law accommodates legitimate business partnerships. The key is contractual safeguards and transparency, ensuring that outsourcing or collaboration does not weaken privacy protections. GLBA imposes limits on redisclosure and reuse of non-public personal information. When a third party receives data under an authorized exception, it may not redisclose the information for its own purposes. This prevents sensitive information from spreading unchecked once it leaves the original institution. For learners, redisclosure restrictions underscore the principle of control. Consumers, data may move for necessary functions, but its use remains bounded by the original context. This maintains a protective chain of custody, reinforcing trust that information will not escape into uncontrolled circulation. Another unique provision addresses pretexting, or attempts to obtain consumer information under false pretenses. GLBA explicitly prohibits social engineering tactics such as impersonation, phishing, or misrepresentation to gain access to customer records. This prohibition recognizes that privacy risks are not only about institutional practices but also about external threats. For learners, the pretexting provisions reflect early recognition of social engineering as a privacy hazard. They align legal compliance with cybersecurity awareness, showing how law adapts to evolving threats by criminalizing deceptive practices that bypass institutional safeguards. The Safeguards Rule complements the Privacy Rule by requiring financial institutions to implement written information security programs. These programs must be risk-based and tailored to the size, complexity, and nature of the organization. They must identify reasonably foreseeable threats, assess vulnerabilities, and implement controls to protect customer information. For learners, the Safeguards Rule illustrates how privacy and security are inseparable. Transparency through notices is valuable only if it is backed by robust technical and administrative protections. The rule codifies the expectation that institutions actively defend data, not just disclose how it may be shared. Risk assessment is the cornerstone of the Safeguards Rule. Institutions must evaluate potential threats to confidentiality, integrity, and availability of customer information, ranging from cyber attacks and insider misuse to physical theft and natural disasters. The goal is not to eliminate all risk, but to identify and mitigate foreseeable threats. For learners, risk assessment reflects a pragmatic approach to security. It ensures that controls are not random or generic, but grounded in an understanding of actual risks to the institution and its customers. This process-driven model mirrors best practices in cybersecurity and risk management. Access control and authentication expectations under GLBA require that institutions implement policies limiting data access to authorized personnel based on business needs. Least privilege principles ensure that employees access only the information necessary to perform their roles. Authentication mechanisms such as passwords, tokens, or biometrics reinforce accountability. For learners, this safeguard highlights how organizational discipline protects against insider threats. By narrowing access and verifying identity, institutions reduce the attack surface and limit potential misuse. Technical safeguards such as encryption, logging, and change management are common elements of GLBA-compliant programs. Encryption protects information at rest and in transit. Logging records system activity for accountability, and change management ensures that system modifications do not introduce vulnerabilities. For learners, These practices illustrate how abstract legal obligations translate into concrete technical measures. They align financial institutions with broader cybersecurity norms while reinforcing consumer trust that sensitive data is being handled responsibly. Service provider oversight is also mandated under the Safeguards Rule. Institutions must exercise due diligence in selecting vendors, ensure contractual obligations for security, and monitor compliance. This prevents weak links in the supply chain from undermining overall protections. For learners, vendor oversight reflects the recurring theme of shared responsibility. Privacy and security obligations do not end at organizational boundaries. Contracts, monitoring, and audits are necessary to extend protections across interconnected financial service ecosystems. Finally, GLBA requires accountability at the governance level. A board of directors or designated senior officer must approve and oversee the security program, and institutions must maintain written documentation of policies, risk assessments, and safeguards. For learners, this governance requirement underscores how privacy and security are leadership responsibilities. They cannot be delegated solely to IT departments. They require institutional commitment at the highest level. Governance ensures that privacy and security are strategic priorities, integrated into business decisions rather than treated as afterthoughts. For more cyber-related content and books, please check out cyberauthor.me. Also, there are other prepcasts on cybersecurity and more at baremetalcyber.com. The interagency guidelines establishing information security standards outline how banking organizations must implement the GLBA Safeguards Rule. Issued jointly by federal banking regulators, these guidelines provide detailed expectations for risk assessments, control design, and oversight mechanisms. They emphasize administrative, technical, and physical safeguards that protect customer information throughout its lifecycle. For learners, the interagency guidelines illustrate how regulators translate statutory requirements into operational detail. By providing consistency across banking organizations, they establish a common baseline of security practices while allowing flexibility for institutions to tailor controls to their specific risk environment. Non-bank financial institutions, such as mortgage brokers, auto finance companies, and payday lenders, fall under the jurisdiction of the Federal Trade Commission for Safeguards Rule enforcement. The FTC has updated its rules in recent years to require more prescriptive measures, including encryption of customer data, multi-factor authentication, and designated information security officers. For learners, this demonstrates how GLBA adapts to evolving threats. Non-bank entities, often smaller and less resourced than major banks, are held to the same high standard. The FTC's specificity provides clarity and raises expectations, ensuring that consumer protections are not diluted outside traditional banking. Incident response planning is another critical component of GLBA compliance. Financial institutions must be prepared to identify, contain, and mitigate data breaches involving customer information. Many regulators also require notification to customers when unauthorized access occurs, aligning GLBA with broader breach notification frameworks. For learners, incident response highlights the practical realities of modern financial privacy. Security failures are inevitable, but effective planning and prompt communication reduce harm and maintain consumer trust. This provision connects technical safeguards with operational readiness, ensuring that institutions can act quickly and transparently when breaches occur. Periodic testing, monitoring, and program adjustments ensure that GLBA safeguards remain effective over time. Regulators expect institutions to conduct vulnerability assessments, penetration tests, and control reviews, updating their programs as threats, technology, and business practices evolve. For learners, this reflects the dynamic nature of compliance. A static security program quickly becomes obsolete in the face of new attack methods or organizational changes. GLBA embeds adaptability, requiring institutions to continually test, learn, and adjust, keeping defenses aligned with the shifting threat landscape. Training and awareness programs for workforce members are equally vital. Employees at all levels must understand their role in protecting non-public personal information. Training typically covers phishing awareness, secure handling of customer data, and procedures for reporting incidents. For learners, this requirement reinforces that security is not just a technical issue, but a cultural one. Institutions succeed when privacy becomes part of everyday practice, supported by informed and vigilant employees. Training turns policies into habits, making compliance an organizational strength rather than a regulatory burden. Records management practices under GLBA require institutions to align retention with operational needs while ensuring secure disposal of customer information when it is no longer required. This prevents unnecessary accumulation of sensitive data and reduces exposure to breaches. For learners, retention and disposal demonstrate how lifecycle management is a key privacy principle. Protecting data while in use is not enough. Organizations must also manage how long it is kept and how it is destroyed. Shredding paper files or wiping digital storage are not just best practices, they are compliance obligations under the Safeguards Rule. Examination readiness is a central expectation for regulated entities. Banking regulators and the FTC conduct reviews to ensure institutions can demonstrate compliance through documented risk assessments, training records, audit logs, and vendor oversight reports. For learners, this underscores how GLBA compliance is evidence-driven. Institutions cannot simply claim to follow the rules, they must prove it through documentation. Examination readiness fosters accountability and transparency, ensuring that compliance programs are not theoretical but operationally robust. Enforcement mechanisms under GLBA include civil penalties, consent decrees, and corrective action plans imposed by regulators such as the FTC, OCC, FDIC, and Federal Reserve. Institutions found lacking may be required to overhaul programs, report progress, and sometimes face public orders that affect reputation. For learners, enforcement illustrates how GLBA maintains credibility. Laws without consequences lack impact. Enforcement ensures that institutions internalize privacy and security as essential obligations, not optional practices. GLBA also interacts with state privacy laws, creating an important area of exemptions and coexistence. Many state comprehensive privacy statutes, such as those in California, exempt data already regulated under GLBA from certain provisions. This prevents duplication and conflicting requirements. However, state laws may still impose additional obligations on financial institutions in specific contexts, such as breach notification or insurance regulation. For learners, this demonstrates the patchwork nature of U.S. privacy law. GLBA sets a federal baseline, but states can and do layer additional protections, requiring institutions to navigate both frameworks carefully. Federal preemption under GLBA is limited, meaning state laws that are more protective generally remain valid. For example, a state may mandate faster breach notifications or stronger restrictions on sharing insurance data, and those laws coexist with federal obligations. For learners, this highlights the principle of floor, not ceiling, in U.S. privacy law. GLBA establishes a minimum standard of care, but states can raise the bar. Institutions must monitor state developments closely to ensure full compliance across jurisdictions. The insurance sector provides a clear example of state-level alignment with GLBA. Through model laws developed by the National Association of Insurance Commissioners, states have adopted privacy and security requirements that parallel federal rules. These state laws often incorporate GLBA standards while tailoring them to insurance-specific contexts. For learners, this shows how federal and state frameworks harmonize. Industry-specific models create consistency, but variation still exists, requiring institutions to remain attentive to jurisdictional differences. Consumer transparency remains at the heart of GLBA compliance. Notices must be clear, conspicuous, and accessible, avoiding legal jargon that obscures key information. Regulators emphasize that consumers should be able to understand how their data is collected, used and shared without confusion. For learners, this focus demonstrates the enduring importance of plain language. Privacy rights lose their force if consumers cannot comprehend them. GLBA continues to stress clarity in communication as a critical aspect of consumer protection. Third-party risk concentration has emerged as a modern challenge under GLBA. Institutions increasingly rely on cloud providers, payment processors, and other critical vendors. Regulators expect heightened oversight of such providers with contractual requirements, audits, and escalation processes for high-risk partners. For learners, this reflects the interconnected reality of financial services. No institution operates alone. Compliance depends on ensuring that vendors uphold equivalent standards. Vendor risk management becomes not only a security necessity but a regulatory expectation under GLBA. Finally, programmatic harmonization is essential. GLBA obligations overlap with other rules, including the FCRA, the Red Flags Rule, and breach notification statutes. Institutions must design programs that integrate these requirements, avoiding duplication and ensuring efficiency. For learners, harmonization illustrates the value of a unified compliance framework. Rather than treating each regulation in isolation, organizations benefit from building comprehensive programs that address multiple standards simultaneously. This integration strengthens security while reducing operational burden. In conclusion, the Gramm-Leach-Bliley Act creates a durable framework that combines privacy notices, opt-out rights, and strong security safeguards. Its privacy rule promotes clarity and transparency, while the safeguards rule ensures robust protections against evolving threats. State laws extend and refine these protections, demonstrating how federal and local systems interact to strengthen consumer rights. For learners, GLBA offers lessons in notice clarity, security rigor, vendor oversight, and the interplay between federal baselines and state enhancements. It remains a cornerstone of U.S. financial privacy law, reflecting both regulatory foresight and ongoing adaptation to modern risks. Thanks for tuning in to the Bare Metal Cyber Prepcast, your trusted source for cybersecurity news and insights. Remember to subscribe at baremetalcyber.com so you never miss an update. And visit cyberauthor.me for best-selling cybersecurity books that equip you with expert knowledge. Until next time, stay secure and stay vigilant.